David, that is awesome, man. I love it. So dang cool. Premier Group 2024 on the floor. Let's go. Yeah, sorry we have to, yeah, 80 style. Let's go. Sorry we have to get out and get back in. The recordings are just too messed up whenever I've tried to do it the other way. So, um this is the best way to do it that I found. Hopefully YouTube servers are not broken. It took like 7 hours to upload the pre-market yesterday. Just something seriously wrong with it, but apologize about that. All right. Let's get started. Um, Real fast. I'm looking at Crocs for a bear call spread, like a monthly bear call spread. Man, it's kind of lost a lot of premium overnight on this little gap down. Dang. It's only paying it's not bad. So this is a $4 spread because they don't have a 146. They just have a 145, and I want to try to sell the 141. So I just bumped it up one or two contracts to match the same risk as a $5 spread. That makes sense? So that's that's what we did there. Let's get this thing rolling.
I can't really. Oh, April.
Yeah, this is April 19th. I'm just waiting to see if this is enough bearish sentiment for me to want to get in on this. Just kind of looking at the 15-minute. Um, Maybe it work its way back up into here and then see if we can't get paid a little bit more on it. We're at the top side, right? Really, we're getting in off of this, right? We're at the top side of the channel. Ray, I think you found this one. We're overbought at the top side of the channel, and I have lots of resistance in between this area. So if we are not rejecting off of 130, like if we start getting candle closures up above 131, I could either just buy a hedge and it'd be very cheap, or I could just exit the spread for a very small loss. Either way. But 141 is a very easy spot to hedge this. It's already crazy extended. We're getting that pretty good hesitation now, and it doesn't have to go very far in order for this thing to win. So that's kind of what I'm looking at. Yeah, I'm uploading pre-market right now. Hopefully it doesn't take an eternity. All right, so I'm looking at that. We'll watch and see it. Figure out maybe once it gets up into this range here, if it's worth jumping into. And again, just kind of having our alert level through here is what I would be looking at. This would be the place where it's like, it kind of we need to hold below this. As long as we're not getting any strong daily candle closures, I would wait for a daily close up above, 131, 132. If we start getting that and we get into the spread right here, we might be down $200. I can just exit the spread if I really want to. So let's look at that real fast. If we got into the spread right now, and this thing went to 132, yeah, around $250, give or take. And that's because I'm trying to calculate it in. That's as if we got in up here, maybe at like 0.65. So if we got in at 0.65 and this thing went to 132, still be about, yeah, give or take, let's just say $250 is what would be down. So we could just exit it then. Um, we are outside the expected move, which is nice. That helps. So, I mean, this is definitely a monthly credit spread I'm very interested in doing. And I think that 129.18, 129.50. 129.60. Yeah, it 65 cents is probably what it would pay. Do I want to put an order in for that? We'll see. I want to get started on the mentor group, but I'm trying to find more monthly credit spreads for you all. Fed rate announcement is tomorrow. That can mess with this a little bit, which also makes me a little bit more hesitant to get into this Crocs one, but it's a very easy hedge. The Fed's not going to move this stock 10% tomorrow, right? Crocs is not as reliant on that, I don't think, right? It will get some volatility on it, but I think, honestly, I think we'll be just fine with the hedge plan. So that's if it can even get to 65 cents.
Tony, on that particular date, 19 April, they do have a 140, 145.
Yeah, they do.
Okay.
Yeah, I just like the 140. I feel like the 141 is just a smidge easier to hedge if we want. It's just a little bit further away, but I have both of them up on here. So I have the 140, 145, and then I have the 141. So this, I was just going to bump a couple more. I was going to do 12 contracts to basically match the same risk as the one before. So it's about $100 difference, but I get an extra dollar worth of it. Yeah, it's just kind of just up to you, I guess. So like you can kind of see like this is within that expected move, and then we bump it $1, and that could help. This one we'd be down about at $1,200, give or take, at our sold strike. This one we'd be down about the same. It's literally it's pretty much the exact same trade. You might save, $4 in commissions or whatever doing the 10 instead of the 12, but yeah. There was a reason yesterday I was looking at this that I liked oh yeah, and also this does have an expected move up here from this inverted head and shoulder. It has an expected move up to 136, which so happens to be also this resistance area. So that's what it was.
It just seems like there's a lot more premium with the $5 spread. I think it's 57 cents with the one and like 80 cents with the other.
Correct, because this one it's a $4 spread instead of a $5 spread. So I could do a couple more contracts to match the same risk as the $5 spread. So even though this thing's only paying 58 cents, if you look here, it's only about $100 cheaper because I'm doing an extra 2 contracts.
Oh, got it.
But you're 100% right. If we want to make this easier, we could just do the 140, 145. I was just trying to see to get a little bit safer, the difference between here and here. It might not mean a whole lot, but I remember I was looking at something and there was a reason why I liked the 141. I think it was because of this resistance here. It just is really solid, whereas the 140 is just below that resistance. Go either way. Honestly, we're going to be in a hedge long before it gets into there. So I still think 136 is very probable on this. Like it's possible for sure. And we could even just we could move our alert level to 136 and just let it come up into this range at 130 and not even stress about it because so if we made it up to 136, how much would we be down? About $700, $650. So it just makes the hedge harder, right? Because by the time it gets up to we'll be down $200 at our first area, which then makes it very easy to hedge. Or if it gets to here, now I just have to buy a lot more calls because I'm already in the whole $700 before I even start the hedge. So, yeah. We'll see.
There's a little gap fill on the weekly, if you have it on the weekly chart.
Where's the gap fill at?
Like right between like 134.86 up to 135.34.
Talking about this guy right here, or is further back?
Are you on a weekly? 134.86. It is, the date was Monday, the 10th of April, 23.
Right here.
Monday, the 17th of April, 23.
Yeah, there is like this gap is filled, but it could. And if Powell comes out and just pushes these markets up, this could be cranking higher. We could always just wait for a little bit more confirmation and sell one closer, like sell the 135 and wait till after the Fed announcement. Like that's a possibility too. But because it's not like we haven't gone bearish on an hourly yet, which is normally what I kind of want to see. Either a channel break. Pretty good channel there. For our hourly, I would say that's not a bad channel. Like we have really good touches here, and then I just moved it down to the main bouncing spot there. What about here? Meh. That's a pretty good touch right there, too. Maybe it's that. Hard to say. That's the problem with channels. Got to kind of figure out what has the most touches on it. But let's get over here to... We'll think about this one for a little bit longer. Let's dive into what we're going to be talking about today, which is day trading options, because we might be having ourselves some day trades today. All right. Second to read that. So on the agenda, we've got just day trading option tips. We're going to be talking about setups, managing risk, managing the trade, and when to add to the trade, okay? So day trading option tips. There's a lot of little things. Again, I'm already assuming you understand how options work and buying options. We've gone over that. Right. We're not doing anything on that. We're just kind of waiting. But I was looking at April 19th is what I was doing. So before earnings. If you go out one more date, earnings will be there, and then we can't sell that. All right. So the supply and demand game is very important when it comes to day trading options. Remember, everything is leveraged when it's the same day. That's why we love it. We want to minimize our risk and maximize our leverage in day trading options. We do that through our setups and getting in at the right time. Okay. A big part of that is the supply and demand game. We really don't want to be playing with a crowd. If the markets are crashing on a 5-minute, don't jump in and buy puts. Everyone's doing that. It's going to be extremely hard to actually make money doing that way. Okay. You want to let it come in, let it retest. When everyone's losing, we're buying. Now we're having a small risk with maximum leverage. Here you're having leverage with huge risk. You don't want that. You're going to struggle to get ahead. Okay. Your entries are everything with options and everything with day trading options. It's everything. It can offset everything else. Entries are the key. We want to wait for candle closures before making judgments, meaning if I'm not so much for getting into a trade, because again, if let's say your entry's here and it comes down and it bounces up and you're like, I'm going to wait for a candle closure, and then it closes down like this and then you buy puts. Everyone's also buying puts here. You're much better off just buying puts before it actually shows its bare hand. All right, so you don't want to wait for candle closures for entries, but you want to wait for candle closures to really weigh on things, meaning when you're already in a trade, okay? If you have your alert here to get out, and let's just talk puts right now, and you get in here and it comes up, we're going to want to wait for candle closures to the best of our ability. Can you get out of some? Let's say you go ahead and exit half and then wait to exit the other half after a candle close. Sure. It all depends on how much you're down, etc. But you want to wait for candle closures before you make any real decisions on how strong or weak something is. Okay. We're always going to be buying the same day expiration. If you buy something with the next day, it doesn't, you're paying for an entire day's worth of movement you're not going to take advantage of. So again, it's going to really screw with your leverage, and leverage is the reason why we're day trading these options, so that we can make 3, 4, 500% return. You're not going to get those returns with buying it 2 days out without the leverage. If it doesn't have the same day expiration, just use shares. So many people day trade Tesla with options on like a Tuesday, and they buy the current Friday's expiration. You're paying for like 4 days worth of a move, and you're only getting in for that much of it. So you're paying for this big of a move, and you're getting in and out right there. You're not going to make any money. You might as well just do it with shares. Okay. So you have all the risk and all the theta. It's going to lose very quickly, but it's going to really struggle to make any kind of serious money. So just do shares. If you don't have the same day expiration, do shares. You can't view trading options like you do with shares. Okay. The value of the option is not just from the price movement. Okay. It's basically the value of that option mainly is determined by the probability that your option will be in the money by end of day, right? Is it going to have any value by the end of the day? And that's what your current P&L is being based off of. What are the probabilities of it actually working out? I'm always buying limit orders instead of breakout plays. So I do market on SPY for day trades, in and out, doesn't matter. It's 1 or penny slippage, not a big deal. I'm not doing stop limits. So I'm not buying breakouts. So if I have a bear candle here and I want to buy the breakout of it, I'm going to let it close and then get in on a retest, because if I'm buying here, I'm buying it on the way up, which is what everyone does, which inflates that price quite a bit. And if it retests, you'll be down a lot, even though it's back at your same entry spot. So a few little tips on day trading options. All right. Our setups, channel, S-curve, and trap setups with day trading options. That's what I stick towards. It works. You can put your own twist on your own strategies. Just make sure you understand the rules. I'm usually always buying a 40 and 35 delta. There are times where I'll go a little bit more out of the money, but it needs to be those times where it's like, I don't have the confirmation that I want. I think it can make a large move, and I really want to be prepared to capitalize and have the littlest risk as possible, understanding that it has to be perfect. So that's the only time I'd go further out of the money, but 99% of the time I'm buying a 40 or 35 delta. Again, you're buying the same expiration. Trade it with shares if it doesn't have it. Let's talk about minimizing risk, because with options, they have little cheats in there where you can have small risk and high leverage. That's what we're after on these day trades. Okay. You can use a physical stop to manage your risk. So you can do that. You can actually use a stop. This is very useful if you are at work and you're not able to manage it. Like, put a stop in there. Sure. You just need to understand that the option price can move very drastic. So if you were buying calls and the stock makes this big of a move, your option can make that big of a move, right? SPY is a little bit better, but still, any option is going to be leveraged. It's going to move way more than the stock is going to move potentially, which means if you have a stop here and you're like, oh, the stock never even made it to my stop, it doesn't mean that your option won't make it down to your stop. Okay. Do you all need help knowing how to put stops on your options? Do you understand how to do that? Oh, I need to move it over here. So if we went to SPY right now, you understand? We're good. I'll give you a little example. All right. So if we went to SPY and we bought a put here, you know, we're actually gonna have to have this. I'll do it on my swing trade. Dang it, this screen's not over here. Can I move this screen over? Where the heck is it? All right. So there are a few little ways. I'll spend 2 seconds on this. If you get the actual symbol So for this option, I'm going to use our swing trade as an example. Okay. Can I move this thing over here? Yes, I can. Okay. I am then going to type in this symbol. So the symbol for my swing trade right now is, I just copied and pasted it because it's going to be crazy, but it's SPY 2020 24032820. That's the date. Okay. And then put for the P, and then 504 is a strike. That's how you type. Just go to your broker. Just go to your broker. You can even do it on the options chain. Right click and say copy symbol. It'll do that there. Okay. Once you copy that symbol, then move it out. Usually for a swing trade, you're going to be on a daily chart, but here's the value of that option right here. Okay. If you wanted to put a stop here, you could put a stop and use the charts and go, okay, well, we have a this thing hasn't gotten below $1.06. So I could go ahead and put my stop at $1 if I wanted to put in a hard stop. That's how you can figure out how to do that. So step number one way of doing that is just actually going to the option chart, this guy, and you do that by copying and pasting the option. You can't do that on TradingView. TradingView will not carry that option information. It's too much data. You have to do it through your broker. But you can do that, and you can determine based on the chart where you want to put your stop. That's just fine. Another simple way of doing it, move this back over here. Another simple way of doing it is just using some math, right? You can use your analysis tool and go, okay, on SPY, I want to get out of this if we get up above 513. So how much am I going to lose at 513? I'm going to lose $700. Excellent. I can come in now here, close this position, put a stop market, and then adjust this price until my max, my loss equals $700. So if I put $1 in here, there you go. Oops, it moved it. So if I put $1 in here, there you go, $762. You can figure out that way. So use your analysis tool to figure out where you want to get out, figure out how much money you're going to lose there, and then just put the order in there for you to lose that much. Realize that that number can change over time because of theta. But it's a decent start. Whenever you're working with day trading options, as long as you can manage it for a little bit, it's not a bad way to go about it. Okay, that's how you can put your stops into your broker. Okay. You can also just use some math, right? So if you bought an option for $1.50 and you bought 2 contracts, that means you have a $300 max loss. So then you can just put in a stop at $1 if you're trying to lose a certain amount. If you want to lose $100 on that or whatever, $200, put your stop in there. So you use some math. Again, the pricing are going to change some, but cool. Again, the downside of using an actual stop is that options can get spready, they can move a lot more, and they can stop you out even though the stock never really even moved, okay? A better scenario is to put alerts out there, all right? This is what I like to do. And one of my favorite things to do, so let's say I have an alert at 5:15 to get out of this option, okay? I can go to my broker, I can click on this guy, I can close position, I'm going to put a market order in. And then on my broker here, I'm going to click activation rule. You'll need to figure out on your specific broker how to do this, but you click that box on activation rule and you click the 3 dots right next to it. Now I can go to price, type in SPY, go back and you can rewatch this thing and press add. Now I can type in a price. So basically what I'm doing is when SPY gets to this price, I want you to activate this order. That way I can have an exit price at the chart location that I want without having a physical stop in there. That way the chart, the stock itself has to move to, let's say 517 or whatever the heck I want my stop to be at. And so I go, whenever SPY is greater than 517, which I don't know why it didn't stay. Whenever SPY is greater than 517, I want you to activate this market order. You can't do this with a limit order because we don't know what the limit price is going to be. It needs to be a market order. But this is one way that you can manage a trade without ever having to be there and not get stopped out prematurely on a trade. But you need to realize your option can lose a lot more than your $700 that you planned on, because by the time this hits 517, it might be down more than that. So you need to use your analysis tool and make sure that you're getting yourself close to that area. But this is one really effective way. If I can't be at the charts, this is what I do every single time on long trades. So swing trades, anytime I'm buying, long means buying. If I'm buying puts, if I'm buying calls, day trades, swing trades, I use this if I can't be at my computer instead of putting an actual stop in. Okay.
Yeah, Tony, that may be known as a conditional or a conditional rule. With Street Smart Edge, it was called a conditional.
There you go.
Yeah, so just you got to look at the language and you can kind of suss it out.
Yeah, I love it. Or bracket. Yeah, as long as it's exiting at a price, right? Your bracket order might be putting an actual stop on the option price. We want to have an order activate whenever SPY hits this price. Right, so just make sure that that's the determining factor on that. So I use alerts a lot more. You know, when I'm here, my alert goes off. I'll wait for a candle close. If it closes, I get out. So I use my analysis tool to figure out how much I'm going to lose at a certain area, and then I manage my risk based on that. Let's take a look real fast here at SPY. Okay, so SPY had a little 3-minute channel, and it wasn't a great channel. I was just kind of being preemptive. So far, this is not really giving us that big of an up. It's more of sideways than anything, right? Maybe this is what we're going to kind of be in. I don't love that. I would have loved something a little bit steeper. But we'll watch it. That is a channel. We are a little bit higher than that. So maybe we get up into here. Again, this area is definitely a spot that I want to watch to possibly buy some puts. Okay. If I was buying puts up here, I would most likely just do an absolute zero. What is an absolute zero? It's whenever you spend the amount that you're willing to lose on the option. You can't lose any more than what you paid for it. So if you buy $150 with a max loss of puts, that's all that you can lose. You can't lose 500. You can only lose whatever you spend on the option. So an absolute zero means you're buying the amount that you're okay to lose, so you don't even need to stop. You can just let it go all day, just like we're doing on our swing trade right now. I know I'm not going to lose more than $900 on this. Not going to happen, or whatever my max loss is. So I can just let it do its thing, because the upside is you might be losing, and an hour later on a day trade, you could be winning. And so you stayed in the trade because you didn't need a stop. That's the upside. Like right now on the SPY swing trade, I think SPY is going to have a move down to 495 here within days, I think. So I don't want to get out of this option yet, but I just want to stay in it, realizing that the worst thing that can happen is I lose 1R. And the best thing that can happen is I can still make my 2Rs if it gets there. The downside is it needs to make a larger move in order for you to actually make money. So you can't do these on little tiny baby moves. You're going to need large moves in order for you to actually make any money on this, because our goal is 100%. And this might need to make, 100, 200, 300% in order for it to be super effective. Because if you're wrong and you're losing 1R, and when you're right and you're only making 1R, it's going to be a struggle to ever get ahead. So one needs to give. Either you need to cut this and lose small, or you need to catch some really big home run winners with this strategy with absolute zero. So that's the downside. Most of the time, absolute zeros are my kind of feeler. Whenever a stock gets to my entry spot, I will buy an absolute zero. So like right now on day trades, I'll buy $300 worth of puts on day trades when SPY gets to that area. If it works, I will then add another day trade. And the one that I add is going to actually have a stop. Either an alert or a physical stop, but I'm not going to let it lose its full amount. So normally my first leg in is an absolute zero, because it gives me time to be wrong without having to stress about it. And then if it works, I didn't get stopped out to lose an R for no reason. Okay. I have to be dead wrong in order to lose my full amount on that. Sometimes that happens, but most of the time it can at least start to work. And if it really works, that's where I'm like, okay, retest, add the next position. And now I'm making way more money than my original risk because I've added size in safely. So my first entry in is usually an AB0, an absolute zero. So on SPY right now, oh, come on, SPY, get up here. So on SPY, if we do get up here, I'm going to be buying $300 max loss of puts. Because there's no guarantee that this thing is going to come rolling on down. It just makes sense based on the price action, based on all of this. Failed that 10 EMA on an hourly? Good. Finally, let's get some freaking bears through here. But if this can come up through here, I want to do a safe way, right? I want to manage my risk, give myself some time, because it's possible that maybe we do this and then it drops. If I got into options here, I'd have to exit them here if I had a stop, which means I'd get in and lose and then it'd work later on. My first leg in is kind of the feeler leg. It's like, all right, well, let's see if this will work. I can give it more time to see if it'll work and manage my risk. And if it does work, great. Now I can add in my extra size and rock and roll with this thing. Any questions on that so far for managing risk and kind of how we set these things up? So with options, it gives you options. Sorry, I didn't realize my thing's not on. It gives you options where you can kind of feel things out and still have some skin in the game, right? So up through here, I don't know if this trade's going to work. This is not the greatest setup in the world, but based on the gap, based on sentiment, based on the 15-minute 10 EMA, there's a lot of reasons why this should start to drop. So I want to put a feeler trade in up here. Do I want to put a feeler trade right here? I could, but remember what we talked about earlier. Entries are everything. If I buy it here, where am I wrong? Up here, which means I have this much risk right now. If I buy it here, where am I wrong? Right here. I'll know very quickly and can lose very small if I'm wrong. Entries are everything. Have a really good reason to do it. Be willing to be missed out on trades to get the best entry. Right? And if this thing just falls off a cliff, well, then great. I have another entry now. I can retest this channel, get in short there, and get rocking and rolling. This, now that I have the confirmation, do I need to do an absolute zero here? I could. I could still do a feeler on this if I wanted to. That might just be your style. I would probably go more of like stop up here above the new lower high, and then just, I don't want closures back inside of this channel. Like that's probably how I would play it. So a little bit more size, trying to make a little bit more money, because how big of a move can it make if we get in up here? Make a large move. If we get in right here, how big of a move can it make? The same move, that same location, it's a lot less. Here to here is big, here to here is small. So I don't want to be doing absolute zero, because remember what I said with absolute zeros? I need large moves to make them valuable. I don't want to necessarily be doing absolute zeros on normal moves. It needs to be a really good risk reward. So up in this range, it makes sense. So if we were going to day trade
Tony?
SPY, yeah, go ahead.
So in that same example, if you waited until it got up a little higher, like you just showed, and you're doing something like shares or futures, anything like that, you could have a smaller stop, which will allow you to make more as it goes down, correct?
Correct.
You don't have to have a wider stop.
I mean,
Yeah, with the tool.
I would still do, so I would not do this, because this line is your 1R loss.
I mean, you could put it above the green there, the 15-minute.
I would still do a wide stop. That way I can lose half an R if I know I'm wrong right here, right? That way I can lose small, but still win big because my 2R is right here. Right?
But if you got in lower, you'd have to have even a bigger stop range.
Correct. So this dotted line is where the original 2R was. If we get in down here, and I would have to move my stop up.
Yeah, that's what I meant.
Yes. We're at 0.8 R's where everyone else is getting 2 R's. That's the difference. Yep. So you can get much better risk reward. Even having your stop loose. Like I don't recommend doing this. You'll lose 1 R all the time. It's very, very hard. You want to give yourself a little bit of room where you can lose small. You'll know you're wrong here, cut it. Instead of losing 1 R, you lost half an R, and your risk reward is still awesome, right? So if we're going to set this up with options, because we're talking about right here, sorry. What are we going to buy? Well, we know it's going to be up into this range-ish whenever we're getting into these options. So we could be buying pretty much one strike out of the money. It's going to be around the 511 strike. It's about one strike out of the money is what we're at. So that's about your 38 delta. That's kind of where we want to be at. It might even be the 512. It just depends on how high this thing gets and where we're at. But the 512 might be the one that we buy. Either way, let's calculate this off of the 511. We'll do both. I already have the 511 on there. We'll do 512. So we'll have both on there. So I have them on my analysis tool right now. And this is a trade I will actually take. So now we need to figure out our size. Okay. So remember, what am I planning on doing up here? A stop or absolute zero? Absolute zero. So I want my R right now with my account is $300. So I need my max loss to be $300. They're about $1. So that's easy math. I do 3 contracts. Again, it's $1 right here. What is it going to cost when it gets up to our entry? How do we figure that out? First thing, you could just wait to see what the price is when it gets there. Or you could use your analysis tool. I think it's going to be about 512.15 or so. So hold my mouse over 512.15. 512.15 is going to be about $34 cheaper than it is right now. Okay. So it might be 90 cents. So could I get away with 4? It's a little bit higher. You could get away with it. Again, it just depends on where this thing is at. If it's within about $100 or $50, then I don't mind it. So you could do 3 for sure. 3 is under your R, or you could do 4. What if you bought the 511 strike calls? We could probably do about 6 of those easily. So you could just do more contracts, but what's the downside about doing the 511s up here? If it comes down and then kind of hangs out, you're going to get beat up. Why? Because your strike is down here. It needs to be deep in the money. If we bought the 512s and this thing comes down and hangs out, you're going to hold value much better. So it's up to you. How strong of a move do you think we could potentially make? If it does this, their 511s are going to pay you a fortune, way more. Why? Because you can buy 6 contracts instead of 4. You're just getting more money out of it. Make sense? So it's up to you on which one we want to plan on. So let's go back here and look at this. Right now, your 511, which is time to get in right now, is at a 30. So I'd probably buy the 5. Go either way, whichever one you want. I would love for it to get up to this EMA up there and see what it does. I could even probably add on. Let's do the 512. So market order that thing, and I'm gonna wait for it to get up to this EMA. I think this is about the spot where it's going to start pulling down. We've got lots of candles in a row. There we go. Now it's time to grab. I could actually probably grab 5 of these now because it's so cheap. Yep. So buy it. So, oh, I got to post this over into the thing here.
Order filled.
5, what did I buy? 511? No, 512 puts.
Expiring today.
Expiring today. Yep. I got filled at 75 cents. Excellent. Now, how do we manage it? What a perfect timing to be able to teach day trading options while we're doing a day trade. First things first, what's the most important thing? That we have a reason for this thing to go down. You've got to have the direction. You've got to have a reason. Remember, we could have bought puts down here and you'd be getting crushed. Who is buying puts right now? Only the smart ones. Does it mean that it's going to work? No. But by me buying puts here, I can lose small risk. And if it works, high leverage. That's how you want to day trade options. Entry is everything compared to buying puts here. So it's all about, number one, reading price action and realizing this gap is extremely bearish. We were super oversold. What did we need? We needed some up channels to form. We connected our up channels. We drew it to the top side. Now we want to see if this can close below that, we're in really good shape. Let's go. That's a great candle. Look at the volume coming in. That's people getting in short. That's bulls taking their profits that got in here. That's noobs buying this breakout, right? So we have multiple reasons why this thing would go bearish. First off, it's bearish. Strong bear gap down, strong bear sentiment. We've got the 10 EMA on a 15-minute sitting right here. We've got an up channel. We've got a lot of things, not to mention 1, 2, 3, 4, working on 5 bull candles in a row. Okay. What is the worst thing that would happen on this? The worst thing is I lose 1 arm. So I can allow this to kind of screw around for 30 minutes. Sure. Because the worst thing is I'll lose about $300. Half the day will go by and I will be down $170 if we're up here. Great. If we do this, I will change my expectations and I will be looking to take a lot more profits, if not all down here, which I think will happen. If this works right away, I will tend to hold a lot longer. Remember, we talked about our green setup. So this is still a potential green setup right now. It respected our entry, so we know it's not a red. This candle didn't just blow right through it, right? If we hang out up here for a couple candles, at least 2 candles, and we're not really moving in our way, we know it's a yellow. 90% of my trades are yellow setups. Most of them are. It's not bad. It's just yellow setups. I'll take a decent 30% chunk off at my 1R, and I'll see if we can make it to 2Rs. I'm not planning on 4 or 5Rs. If it hits and just rockets, that's a green setup. Remember, it needs to be within 2 candles of getting in. So if this thing starts to crash down, it's a green setup. Take less off here and see if we can't break this guy and get going. Because really, where was our target at the start of the day? Right here, 509, 509.50. On our options, if we make it down to 509 today, that is $900. That is a 300% return. That would make our whole week right there on this one day trade. If it works. If it doesn't, there's a really good shot. If this thing makes it all the way up to 514, we're going to be down $150. Makes it all the way up to here, I'm still down half an hour. How cool is that? Options done right have a small risk and a huge leverage for a reward. That's how you trade them. Okay. Our time is just about up here. So now, if we would have loaded in, so far it's looking more like a yellow setup. If we would have loaded in here, I would have to have a stop, probably like right here, like at least an alert where it's like, I've got to get out because I can't, like, if I let this thing come up to here and I have 20 contracts on, I'm going to be down $1,000 when my R is $300, right? I can't do that. But because we bought $300 worth of puts, we can sit back and let it go. So if you have a job, this is one of the easiest ways to day trade. Sit back, see what it does. Come back and check on it in 45 minutes. If it's kind of not doing its thing, awesome. We'll kind of just look to get back out of this at break even, or maybe a small win, or it's going to lose. Just lose small. But you get the luxury of time. Now, you don't have all day, of course, but we know worst case scenario, there's a 90% chance that I'm going to lose less than 150 bucks on this. 90% chance. Yeah. That's the one thing. Remember, we didn't want this to happen. We wanted this gap to stay open because that would be an abandoned baby and then it'd be great, but it wasn't meant to be. But the gap is filled. Remember, we have to, number one thing, you've got to have a reason of why it's going to do what it's going to do. And then you decide how you want to trade it, how aggressive you want to be. Do you want to put in large size and do 10 contracts but have to have a stop? Do you want to just kind of put in a feeler, absolute zero, that allows it to kind of do its thing? Because I'm pretty sure it's going to roll down. And if it does roll down and then kind of crank through, there's our second trade entry. This one's not going to lose anymore. Second trade entry, I move my stop down on this one. So if it doesn't work, I'm exiting both and I'm going to still be green on the day. Does that make sense? And now I have an extra put here, different trade. Again, both of these will have a pretty tight stop. And if this rolls over, now we're making $2,000 instead of 900 bucks. And our risk was not increased. If it works, we'll see. But this would need to really start cranking. If this just kind of, then most likely when it comes down to here, I'll just exit and just kind of call it a day. And I don't think we're going to go a whole lot more than that. I won't add. If this over the next 15 minutes really starts cranking and we get a strong move through the up channel, yeah, it's time to add, because I think 509.50 area is our target for the day. Like, that makes complete sense. So cool. Now we sit back and wait. But that's how you do that. So there's the difference between those few. And you get to choose on what style you want. You get to choose on how aggressive you want to be, et cetera, et cetera, et cetera. All done by managing risk. That's the most important thing. So any questions on that at the moment? Are we good? Does that kind of make sense? Are a few more light bulbs clicking a little bit more on how we're buying these options, how a few scenarios that we might have? We'll make that happen. If these markets will just do what I want them to do, that's always the case, right? If I can align myself with these markets, if I can align with them when they're ready for a pullback, this $30,000 account will be 60 grand by the end of the year, if they give us an opportunity. I don't have time really. So Natasha, I would just say rewatch this recording over and over and over and over again. Pause and rewind, pause and rewind. That might be the easiest. But basically, you have, when we're talking about minimizing risk, you can actually use a physical stop. You can just put an alert out there and use your analysis tool to figure out where your alert should be at, so you don't lose that much, and then get out whenever it closes across your alert. Or you can use an absolute zero, which is what we just did, by the amount that you're okay to lose. But ideally, I don't have enough time on this. We have to get going right now, but just rewatch the recording. I'll post it as soon as this is over with, and then however it goes.
But did you maybe also said, I don't know, it was just so much. Did you say, like, if we enter and we think it's good entry, and we set up the already sell price, can we do that also? Just to guess certain.
You can. Yeah, I normally won't, because a lot of the times you'll make way more than you expected. So if you're like, all right, I got in at $1, let me just take my target at $2. I would rather just, you can do that and there's nothing wrong with it, but I like to just let because the options can explode. If this thing drops hard, you'll be up $3 in like 5 minutes. So I would rather have an alert out there and just let the market tell me what they want to give me instead of me put orders in to get out. I tend to make more money trading that way. Now, if you can't manage it, let's say you're at work and stuff like that, then yeah, put orders in and let it hit those. I normally won't. I'll just watch and see because a lot of the times it's better than just like getting in right there. I could have put an order in to get it at 90 cents, which is what I thought it'd be at. And I got in at 75 cents. So I'd much rather just let the price show me what it's going to be and then press enter than to be like, it's going to be 90 cents and then me lose 25 cents.
Right.
$25 a
And-
contract.
And sometimes, like now on oil, the price was bid 11 and the ask was 9.50. So, and there was nothing in the middle. I mean, so
the
what do you do
mid-
in that case?
The mid, your broker
wanna
should show
sell?
you the mid. The mid is the price in between. That's the price you're trying to get filled at. So either you need to do the math and do the midpoint, but your broker should show you a midpoint. I don't know how Interactive Broker works, but I know they show a mid.
Okay, but if you put the mid and it doesn't go through, so what do you do then? You
Then you
add a little
cancel and
bit more?
replace and put it to what the mid is currently now. So if you put a mid in at 75 cents and then it goes to 80 cents and you don't get filled, then change it to 80 cents. Hit cancel, replace 80 cents. If that doesn't fill you, cancel, replace it to whatever it is. For me on SPY, I just market order on day trades.
Yeah, me too on SPY.
But yeah,
on
that's what
this
you would
other-
do. On other tickers that you don't want to market order in, yeah, you just change to whatever the mid is. So give it 5 seconds. If it doesn't fill you, change it to the new mid. And I'll do that within about 10 to 15 cents sometime. Well, it depends. Bump it once or twice, and then after that, just leave it there. And if it doesn't fill you, it doesn't fill you. But that's the key. You've got to get in before it starts to react. That's why as soon as it hit that EMA, I just pressed enter. I don't wait and see what it does because that's going to completely change. It could be 20-cent difference by the time you're looking at getting in. So, yeah. Questions? Totally, Joe. Agreed. Yep. 509.50 is a really important level. So, yeah. But a lot of the times I'll just put an alert and then just mark it in only on SPY, but mark it in on SPY whenever it gets to my area to time to get in. All right, my friends, this was great. We'll meet again this evening to go back over this stuff again and give you different examples of it and how to manage it and what to do. And we'll do some practice stuff and back trades and it'll be fun. Until then, I'll keep in the loop of what we do on this here day trading. Maybe it works, maybe it doesn't, but we've set ourselves up where we can lose tiny and win big. And that's our only job. Now we just see what the markets give us. Have a great day, my friends. See you guys.